What's up, everybody? I am filming today from my wife's office, so you can kind of see huge Disney fan, see her Mickey stuff. But, you know, like I said, I want to start filming from around the house to change the pace from the office. So, getting into it today, I've been looking at my portfolio and I've been thinking about how I want to position myself for 2026, no matter what the economy looks like. Whether it's up, down, I just want to be prepared. And in doing my analysis, I found 5 of my favorite ETFs that had zero NAV erosion while paying me pretty healthy distributions this year. And I'm planning to continue to grow these positions in 2026 to stay on the zero NAV erosion train. If that's what you're wanting to talk about today, let's get into it. Welcome back, guys. Rico here. Again, today I'm sharing 5 income ETFs I'm personally invested in that have shown zero NAV erosion through 2025, or maybe slight, but I'm not worried. And this is why I believe they'll stay strong heading into 2026, and I'm probably going to add some positions. So if you're looking for a reliable monthly income without eating away at your principal, this is the one to watch. And remember, this is not investing advice. I'm not a financial advisor and I'm not your advisor. Always do your own research before investing. Okay, so let's start. So all this information I got from Snowball Analytics, and it's based on analysis I did on November 11th. So when you're seeing this, it might be a few days old, but you know, I was getting ready for 2026. So that's why, you know, I was doing this last week. So what no NAV erosion really means. And when I say zero NAV erosion, I'm not talking about temporary drawdowns. That kind of happens to everyone. I'm talking about the funds that don't pay dividends by draining their own net assets. So that can be considered return of principal. So in other words, they're not paying you from your own money. And this is where a lot of people say like, oh, it's ROC, return of capital, which is a little bit different than return of principal. And I want you all to make sure that you understand the difference. So these folks, their NAVs have stayed flat or positive throughout 2025, even with all the volatility that's been going on. And because of their income generation, it comes from options, premiums, and underlying performance, not principal return. And again, don't confuse this with return of capital, which is a more tax efficient way of deferring capital gains while still using options to generate income while maintaining their net asset value. So a lot of these funds will use return of capital to be tax efficient, but they're not using return of principal, which is actually giving you your money back, which some people conflate. So let's look at how each of these performed this year and why they're strong candidates for me and stability in 2026. So first up, SPYI, the NEOS S&P 500 high income ETF. And the price as of the date of this recording, November 11th, is $52.98. And it's up year to date 4.25% just in price. So it started at $50.66 and it's up around $53 today. The distribution yield is 11.57% and has an expense ratio of 0.68%. And the dividend growth streak's been going for 2 years. So that's great because it's only been around for 2 years. And to see that it's grown their distributions in those 2 years is fantastic. So SPYI, it uses a covered call strategy on the S&P 500 and it delivers steady monthly income for me while maintaining its principal, which is very important for this list. And even during the April-May market dip, Liberation Day, SPYI held its ground, proving its income engine runs without sacrificing the NAV. It's one of the few double-digit yield ETFs that still appreciates over time. You'll see the next one. It's also by NEOS, but that's the combination we're after for income today and growth tomorrow. Okay, number 2, QQQI, which is the NEOS Nasdaq 100 High Income ETF. Current price is $55.07, and it's up in price alone 5.16% year to date. And it yields about 13.45%, and it has that same 0.68% expense ratio that SPYI has. And again, I love this. Its dividend has grown in the 2 years it's been around. So like I said, QQQI, it mirrors SPYI the same. The models are the same, but it goes off of the Nasdaq 100. So it captures tech upside volatility while generating income through call options. So same strategy, just different index. And when the market pulled back in mid 2025, QQQI stayed remarkably stable. And then it bounced back even stronger. So its NAV trend has been positive all year while still paying out around 13%. This proves it can be high yield and have capital preservation even in a tech heavy fund, which, you know, tech has been on a bull run for a while. ETF number 3, AIPI, which is a Rex AI Equity Premium Income ETF. Current price, $43.42. And this one's actually down 11% in price year to date, but the NAV has still remained steady. And the yield is 35%, over 35% distribution yield and a 0.65% expense ratio. And it hasn't been around that long, but it did grow its distribution over the last year. Now, AIPI is one of my favorite new additions, especially with how heavy Bank of America, NVIDIA, and other institutions are betting on AI for the next decade. Don't even get into Gemini, Amazon, Apple, all the other folks too. This fund combines AI-related equities with an options overlay, generating massive yield while providing exposure to the tech infrastructure powering the future. And I'm pretty bullish on this. I think AI is the future it's the evolution, much like the Industrial Revolution, things like that. And even though its year to date is slightly down, its NAV has stabilized and recovered from the early volatility in the year. And the distributions are fully covered by option income, not return of principal. So I think of AIPI as the AI cash machine. High volatility, high income, but controlled drawdown. Plus, I'm bullish on the future of AI, like I said earlier, with everything going on in the markets today. You can see my video from last week on other categories that can potentially soar because of the AI evolution. This might be a controversial one. It's number 4 on my list. It's WPAY, the WealthPay Weekly Income ETF. So the price ranges between $25 to $26. It's only been out for a couple months, and year to date it's been flat-ish, slightly positive, and it yields around 18 to 20%, and the expense ratio is 0.95%. So WPAY is one of the newest, most creative income ETFs on the market, and it pays me every Friday, targeting weekly income by selling short-term 0 DTE options. Even with 2025's rate volatility and sector rotation, WPAY maintained a stable NAV while delivering extremely consistent cash flow for the short time it's been around. Remember, it hasn't been around that long, but that's rare for an ETF using such a fast-moving strategy. I like weekly paychecks without NAV decay, so WPAY is the standout performer for me, and I'll likely be adding more of this to my portfolio through the rest of the year and into 2026. And finally now, on my list, number 5, FEPI, which is the Rex Fang and Innovation Equity Premium Income ETF. So current price of FEPI is $47.68, and it's down just a little over 3% over the year in terms of price. It yields about 26.2%, so it has a very strong distribution yield, and the expense ratio is 0.65%. Now, FEPI is pure innovation exposure. So the FANG stocks and other growth leaders like NVIDIA, Tesla, Amazon, Meta, etc. It takes that explosive volatility and it actually monetizes it with call writing overlays. And even through AI rotations, inflation scares, sector pullbacks, etc., FEPI's NAV actually has stayed pretty strong. And that's what makes it special. Massive yield, minimal erosion, and exposure to next generation growth. And as the AI revolution expands, this fund could ride the wave of innovation, much like AIPI, and keep producing income for me in 2026. So I do have some honorable mentions for this list. They're not as high in terms of income payment, but I do have them in my portfolio for some diversification. So those are DIVO and IDVO. So DIVO or DIVO is the Amplify CWP Enhanced Dividend Income ETF, and then IDVO is the Amplify CWP International Enhanced Dividend Income ETF. So both are from Amplify, and they're managed by Capital Wealth Planning. And DIVO, it focuses on US blue chip dividend stocks with a covered call overlay. And then IDVO uses the same strategy, but it uses in international developed markets. So it's my way of diversifying. If the US economy takes a dump, at least I have some international diversification. And so for DIVO, the current price is $45.54. It's up over 12% year to date and has around a 4.5% distribution yield. And for IDVO, the current price is $38.27. It's actually up almost 29% on the year, and the distribution yield is just over 5%. Now, these aren't high yielders compared to the previous 5 on my list. That's why they're honorable mentions, but they are excellent at capital preservation. They've actually grown their NAVs through 2025, showing that conservative dividend and covered call blends can still beat the market and do it relatively quietly. You don't see a lot of videos or a lot of investors talking about IDVO or DIVO, but I include them here because if I'm building a balanced income portfolio, these two, they provide me long-term stability that complements the higher yield, higher income ETFs that I have. So just a quick summary, you can have a look at the top 5 that I have listed here. You could look at them by yield. You can check out their year-to-date performance so far, expense ratio, the dividend growth streak, and the NAV erosion risk. So you'll see some moderate on this list, but for the most part, they are pretty safe. So these are my top 5 for 2025 when I was doing my research, and then also the ones going into 2026 I'm going to continue to invest in and then monitor my positions. And definitely I will be investing in my honorable mentions too, so let's not forget DIVO and IDVO. So what these ETFs have proven in 2025 is that strong income doesn't have to come at the cost of your principal, CULTY. Even with market dips, inflation, tariffs, and all of the economic volatility, these funds maintained or grew NAV while paying double-digit yields. And that's the balance I'm really looking for. Income today, growth tomorrow. I have my retirement accounts that are all in growth stocks, but this is my income. This is what keeps me semi-retired. So I want to thank you all for watching. I really appreciate each and every one of you. If you got value out of this, please give it a thumbs up. Subscribe if you haven't already. It'd be amazing if you'd share it with someone who needs it. I appreciate each and every one of you, and I'd love to hear from you. I'd love you to comment down below. Do you own any of these 7, the core 5 or the 2 honorable mentions? I'd love to hear from you. How do you think about your investing going into 2026? And as always, if it doesn't challenge you, it doesn't change you, messy action is better than no action, and I'll see you next time. Boom.